Howdy, everyone. It's me, Mr. Markets, and today I have a very serious question I have to ask you. Can you afford a house? No, seriously, can you afford a house? I didn't think so. It turns out that in the post COVID economy, housing prices have increased by roughly about 33%, and that's according to Federal Reserve data. If you take a look at this graph, you see, during the 2008 pandemic, everyone became broke, they couldn't afford houses, all that fun stuff with the mortgage-backed security crisis happened. We kind of meandered our way through about the mid 20 teens, and then, there was a little bit of a price activity going up, and, we got a little bit of stabilized growth, and then boom, someone got sick, started coughing in China, and now here we are today, where people can't afford houses, it looks like. But realistically speaking, people have to be buying houses, right? Maybe not so much. According to an article from 2024 from Realtor.com, at the time, the most recently retrieved median household income was about $75,000 a year, and the median housing price was coming in roughly at $410,000 on their website. Everyone knows that it's unrealistic to buy a house with a year's worth of income, so realistically speaking, $410,000, is it really all that bad? Well, for context, using typical financial wisdom, it turns out that if you did the math, if you have an income of $75,000, you should realistically be looking for a house roughly worth $270,000. If the median price that financially responsible households should be buying in at is roughly 65% of the median listed price, that means that well over half Americans can't even afford to enter the housing market right now, so long as they don't have existing equity. So, since over half of Americans, at least half American households, can't afford a house, this leads to an important question. Who's buying the houses? And further, is the term household poor shaming in the year 2025? One of the most common theories that I have heard, and you've probably heard as well, circulating on the internet, is that these large institutional investment firms, think BlackRock, think Blackstone, think Vanguard, have been going up and gobbling up a large portion of single-family homes. But hey, you don't have to listen to me. Listen to RFK Jr. talk about it.
So what's happening? Well, what's happening is BlackRock, State Street, and Vanguard, these giant corporations which own 88% of the S&P 500, are going into real estate. These investment firms swoop in as soon as a house comes on the market. They outbid prospective home buyers with cash offers. They add that property to their investment portfolio, and then they rent it back to you or your children at the most exorbitant rate that the market can bear. So how can our kids or the typical American homeowner win a bidding war with BlackRock? By 2030, these giant corporations are on track to own 60% of the single-family homes in our country.
Wow, Mr. Kennedy, that's a pretty bold claim that institutional investors will own up to 60% of all single-family households by 2030. Now, allegedly, they're going to do it incredibly sneakily through small companies that are financially tied to them that you really can't pinpoint. So, I'm going to do Mr. Kennedy a solid and people like him a solid. And what we're going to do is we're just going to go ahead and assume that 100% of properties that are being rented that are single-family households are owned by institutional investment firms, just for argument's sake. All right, so what's the total makeup of rental properties for single-family households? As it turns out, the answer to that question is kind of complicated. The best source I could find on this was from Pew Research, and it suggests that approximately 36% of the nation's households were rented. This includes all households and not just single-family households. Now, that 36% number is a little misleading because it includes more than just single-family households. So we really want to figure out that number just for single-family households. We're going to have to do a little bit of digging in order to get to that number. So we're going to do something very super scientific. We're going to go in, we're going to find two different data points, and we're going to do a little bit of division. And no one's going to have a problem with that whatsoever because these two data points are from two different points in time. And so surely there's nothing wrong with this methodology whatsoever. Now, even better, I'm going to go ahead and cite a source that doesn't cite his sources and go ahead and say that there's roughly 82 million single-family households in stock in the United States currently. Just based off the wordage that I see in this article, it definitely looks like he is referring to some Federal Reserve data that I couldn't find, so I think I'm okay with using this article as a source. So let's go ahead and let's just go ahead and operate with this 82 million number. There's 82 million single households in the United States. Figuring out how many households are actually being rented is a little complicated, but fortunately someone at Arbor did that work for me, and they found that in 2022, roughly 14.1 million of that stock of single-family households were being rented at the time, which was a decline from previous years, which seems to indicate that there is kind of movement in the other direction. So, there are 14 million households being rented in the United States, and there's a total supply of 82 million. That brings us to an estimate of roughly 17% of single-family households being rented in the United States. That number is kind of subject to a little bit of scrutiny because these numbers are exactly easy to come by. Even the Federal Reserve struggles to come by these numbers, at least in an accurate fashion. Take a look at this article from the Minneapolis Fed. They state in this article that definitive statements about the impact of investor ownership of single-family homes are rare because it's difficult to gather foundational data on the subject. Even the prevalence of investor ownership can be difficult to determine. So finally, to follow up on what Mr. Kennedy said about institutional investors owning 60% of the single-family household supply by 2030, we're going to consider that as unlikely, considering our estimates range from 17 to 36% of single-family households are being rented out. Probably closer to 17%, but let's just go ahead and give a range. And that's also assuming that institutional investors own 100% of the rental properties, which we all know actually isn't really the case. To play a little bit of devil's advocate and to hopefully one day secure a very lucrative sponsorship deal from BlackRock, let's go ahead and hear what they have to say about this. If we take them at face value, and what they're saying is true, which, they probably have some degree of litigation that requires them to at least be mostly truthful here, their stated goals are actually not purchasing up single-family residences. But, they're kind of doing nerdy other lame things, like providing capital for mortgages and new housing construction. So maybe institutional investors like BlackRock and Vanguard and Blackstone aren't to blame for the increase in housing prices in the post-COVID economy. But then, what is? Well, it turns out complicated financial interactions and low housing inventory are to blame. I know, kinda lame. Also, what are these complicated financial interactions, and aren't they in the room with us right now? Well, if you bought your house during the 2020 pandemic, kinda. It's not really dramatic to say that just about everything came to a halt with the onslaught of the pandemic. And there was a lot of pressure for the Federal Reserve to step in and stop the economy from falling off the cliff. This led to the Federal Reserve to increase its balance sheet's total assets by roughly $2.8 trillion between March and July of 2020. I mean, just look at that graph. It's pretty much a straight line when the COVID pandemic hits in. But how does the Fed increasing its assets by roughly $2.8 trillion impact the housing market? Well, it turns out roughly $500 billion of that money went straight into mortgage-backed securities, with an additional $800 billion going in over the next 2 years, leading to a total increase in the mortgage-backed security market for demand of roughly $1.3 trillion. Just look at this graph. In 2020, there was a spike straight up, and then the Federal Reserve continued to lop on those mortgage-backed securities as housing prices were increasing at the hottest. According to analysis done by Western Asset, in 2024, the mortgage-backed security market had roughly $13 trillion in it, which means that $1.3 trillion that the Fed pumped in those 2 years roughly takes up about 10% of the entire demand of the market. This is where these complicated financial interactions start to really kick in. Because, okay, sure, mortgage-backed security demand jacked up like crazy because the Federal Reserve pumped in $1.3 trillion. Well, generally speaking, mortgage-backed securities have an inverse relationship with mortgage rates. You don't have to take my word for it, you can take a look at this article from LendingTree which says so. This means that when the price of mortgage-backed securities goes up, mortgage rates tend to go down, all else held constant. So if the Federal Reserve came in, jacked up demand by 10%, that means that mortgage rates dropped. Which, if we look at this graph, it's not as dramatic, but they were already pretty low, so they only had so far they can go down. You can't have a negative mortgage rate. So mortgage rates depressing and remaining fairly flat because they really couldn't go much lower probably was in no small thanks to the Federal Reserve. Interestingly enough, the price of mortgage-backed securities also kind of fell off a cliff as the Federal Reserve started to unwind their acquisition of mortgage-backed securities in the market. It probably didn't help that investors also knew at the time that the Federal Reserve was going to start aggressively increasing interest rates to combat the inflation that we saw during the COVID economy, and the Federal Reserve did pretty aggressively increase interest rates. Over the course of 1 year, interest rates went to practically 0 to 5%. However, monetary policy can't be the only driver behind this housing price boom, because housing prices continued to increase even after these monetary policy actions stopped taking place. Most likely, the largest contributing factor to why housing prices are up so dramatically is unfortunately the least exciting answer, and that is the supply of new houses has been pretty anemic. In an aptly titled graph from Axios, America's housing shortage explained in one chart, the picture starts to become pretty clear. Housing demand in the 2010s, and especially during the peak of the pandemic, outstripped housing supply by a crazy margin. Just looking at this graph of single-family household starts by decade, we see that pretty much in the 2010s, that number is down by about 50%. But what caused this dramatic dip in housing supply in the 2010s? Well, according to the same NAHB study, it cited that there were 5 L's for why you and I can't afford a house ever: labor, land, lumber, lending, and laws. Labor. As of 2020, when this study came out, there was an estimated 300,000 open positions in the construction sector, and the open jobs rate is higher than it was when more houses were being built in the early 2000s. I don't think there really has been any crazy innovations in housing building technologies since the 2000s, so in order to start cranking out houses, we're gonna need a lot more people wearing hard hats. Land. As of 2020, surveys indicated that 6 out of 10 home builders thought that availability of building lots were low or very low. So, unfortunately, you really can't build a house if there's no lot to build it on. Lumber. In 2018, lumber prices raised by 68% alone, leading to houses being more expensive to build. Lending. Acquisition, development, and construction lending stock is 61% lower than it was in 2008. This means that there's significantly less capital coming in to enable home builders to do their job. Laws. According to the NAHB, over a quarter of the cost of homes can be attributed to regulatory burden, with that number being as high as a third of the costs for apartments. These 5 L's all contribute to what Jerome Powell called the perfect storm as to why the housing inventory was low in the 2010s. Now, finding a study like the NAHB's, where there's this big aggregated effort to figure out how many houses were being built, really only happens about once a decade, so I haven't found any new numbers on that. But what I have found, though, is some information from the Federal Reserve, which seems to imply that housing supply issues may at least be getting marginally better. According to this graph, the monthly supply of new houses in the United States in the 2020s has hit a higher high than it did in the 2010s. This signals that, hopefully, we'll start to see housing prices at least moderate instead of going up at a breakneck pace like they did during the COVID years. While the supply of new houses might be increasing currently, unfortunately, that doesn't mean that housing prices are all of a sudden going to start going down. According to a survey done recently by Fannie Mae, these experts expect housing prices to continue to appreciate annually about 3 to 5%, which is higher than the Federal Reserve's inflation target. Which brings us to reality, where we're probably really just going to see housing prices float around where they are today and hopefully just continue to appreciate at a much slower rate. And there we have it. As fun as it would be for BlackRock and other institutional investment firms to be ruining the housing market for everyone, it turns out it really isn't all that exciting. It has more to do with complex financial markets and low supply of new houses. But If you want maybe a little bit more of a conspiratorial lens on something, which does actually potentially involve a little bit of institutional investors' shenanigans, stick around for my next video. I think you'll like it.